Just wanted to make a say some things and make some things clear about the course. Okay, so first of all, okay, this course is very advanced. If you do not have a lot of experience, it's going to be very difficult to understand. Okay, but in any case, you're just gonna have to put more work. Okay, but this course is for more advanced intermediate traders. Okay, and everything that we're going to see this weekend is going to take form, is going to take shape in your trading, I would say, in about 18 to 24 months. Okay, so I'm going to be real with you guys. I'm not going to give you any bullshit and tell you that you're going to be trading and become a perfect trader in 1 month or 2 months. That's not the case. This is a long-term career, and you have to study it and learn how to trade properly. So from today, give yourself at least 1 year and a half, 2 years for everything to take shape, for you to do your experience, to understand, what I mean, how we trade and everything. So it takes time, okay? So you don't have to rush. Does that mean that it's going to take you 1 year and a half, 2 years for you to trade and be profitable and make money? Not at all. Okay, of course, you're going to be trading way before that. You're going to be a profitable trader. However, for you to master what we are going to see this weekend, it's going to take more time than just 3 months or 6 months. Okay, this is a long-term investment. Okay, so if you did other courses and it's a simple strategy or a simple way of trading that can be applied in 1 week, something that's easy to digest and understand and apply to the market, usually it's not going to be very, very solid for the long term. It might work for the short term. You might have a few good trades, but in the long term, it's not going to be very useful. Okay, so the way you see this course is an investment in your trading career, and you have to be serious or else you are wasting your time. Like I said, I'm not going to bullshit you. I'm going to tell you the truth. Okay, so today is going to be day one, of course, and we are going to focus more on the fundamental analysis and the market sentiment. And then tomorrow we're going to do more price action and, of course, the technical analysis. Okay, so day one, day two. Okay, now since it's not a live course and you cannot ask your questions at any time, at the end of each section that we're going to see in the course, I'm just going to take a few moments for you guys to ask your questions, so you can use the chat. So if you have a question while I speak, just write it down, and when it's time for the question at the end of this section, just write it down in the chat and I will be able to answer it. All right. And I think that's it for the small talk before we begin. Okay, so let's get right into it. So quick disclaimer, classic disclaimer. Of course, the content of this weekend is only educational. There's no financial advice of any sort. Trading Forex or any other market is risky. You should consult your financial advisor before doing that and all that good stuff, right? So let's start with the introduction. Okay, so honestly, the introduction, I put it there just, so you can have a reference page, but we're not going to spend, much time. You guys should already know all of that. So what is Forex? You all know what Forex is. Important thing to mention here is that the daily volume is $5.3 trillion per day. Okay, and if you compare it to the stock market, it's 22.4 billion. Okay, so the difference between the Forex market and, let's say, the stock market, it's night and day. And that's why when I started to trade, I chose the Forex market, since you can scale your account, you have more space to play, and in the long term, if you really take your career seriously, you can trade a lot of money and make a lot of money without having liquidity problems. Okay, so that was why I chose in the beginning Forex over, let's say, trading the stock market or other markets. All right, So trading platforms, MetaTrader 4, MetaTrader 5, CTrader, as you wish, they're pretty much all the same. And I assume you guys already know that. So that's it. Broker, all right. So the question I get the most is, Sammy, what is your broker, or how should I choose the right broker? Okay, so the broker is going to be, the middleman between you and the market, and they are going to enter your transaction on the market for a commission, right? Now, how to choose the right broker? There's three things to look for when you choose your broker. Number one is the most important one, okay? And that's that you have to make sure you deposit your money in a segregated account. And if it's not a segregated account, it's a red flag. Well, what's a segregated account? It means that you don't deposit your money in the broker directly. So for example, let's say I have my own broker, okay, Sammy FX, and you're about to make a wire transfer of 10,000 to start your trading account. And when you see the information, you see that the wire transfer is going directly to Sammy FX. Okay, that's a big red flag. That's a big problem. Why? Because in the case that, let's say, I decide to disappear tomorrow, well, your money is gone. Okay, tomorrow I disappear, I shut down everything, your money is gone, and good luck trying to get it back. Okay, so that's, of course, not good. When you deposit your money in a segregated account, you will see when you make, let's say, that wire transfer of 10,000, you will see that the money is not going to the broker directly. Usually it's going to go to a bank. So for example, Bank of Canada, Bank of Australia, Bank of whatever, where the broker is, okay? And in that case, if the broker decides to disappear one day, your money is not impacted. The broker doesn't have access to your trust account, trading account. Okay, it's segregated, it's separated from the broker, so you are safe. Your money is technically in a trust bank account, and you have access to it whatever the broker decides to do. Okay, so that's number one, very important. How do you know if the broker has a segregated account? Usually they will write it on their website. Okay, so you just do a bit of research on their website. Second option, you can just ask them. You can send an email. You can, most of the broker have a chat, so you can talk to them. Or third option, if you create an account with them and you see the information for the wire transfer, you will see where the money is going to go. And if you see that it's a bank, well, usually it's going to be a segregated account. All right, so that's number one. Number two, the broker must have some sort of regulation in its established country. So the broker can be anywhere in the world. It doesn't really matter. Usually you might see some broker on a shady island somewhere. It's fine as long as there's a segregated account and some sort of regulation. Usually they are going to put their office there because for tax purposes. But when you go on the broker website, you see that most of them have a regulation, even if they are, let's say, in the Cayman Islands. Usually they're going to have some regulation. Let's say in Europe, they might have a regulation. In Australia, they might have a regulation in Dubai. It depends. Okay, but most of the proper brokers have some sort of regulation. Okay, so that's important too. And then number three, I would say the less important, spreads and commission must be competitive. I would say, everyone has the same spreads and commission, pretty much. But if you hesitate between two broker, take the one that you see has the less commission, of course. Okay, so pretty simple once again. Now, currency pairs, we have three types, right? Major pairs, minor pairs, and exotic pairs. The major pairs are all the currencies, the pairs that have the USD in them. Okay, so very simple. They are the most traded pairs in the market. And you see, I put them in red. Okay, so the major pair, I'm gonna differentiate them from the rest of these pairs. So you have the minor pairs and the exotic pairs. So the major pairs, I never trade them, and you should never trade them also. So if you're used to trade Euro USD, GBP USD, USD GPY, From today on, never trade them again. Okay, and then you're going to ask me, Sammy, why should we not trade the USD pairs? We are going to explain that a bit further today. Okay, so I explain why we do not trade them. Okay, does it mean that we don't look at them? No, we're going to use them as a reference. Okay, you're going to look at them, but you're not going to trade them. Okay, we're going to look at them because they impact other currencies. Okay, but no trading for the major pairs. Then the minor pairs, they are a fusion of two major pairs. So for example, Euro GPY is a fusion of Euro USD and USD GPY. And the minor pairs, we are going to trade them. Okay, we are going to select a few of the minor pairs for some reasons that I'm going to explain later on again, and we are going to trade them. Okay, so this is just as a reference. This we can trade, and exotic pairs are more, pairs of emerging economy. There's currency that usually we don't really know about. And exotic pairs, we're not going to trade them on a regular basis, but sometimes if there's a big fundamental event, if there's some reason for an exotic pair to do a huge, crazy move, something that happens maybe once every 3 years, something that happens once every 5 years, we can trade them, okay? So trade, okay, exotic pairs maybe one time per, 2, 3, 5 years, whatever, when the opportunity arises, okay? So major pair reference, minor pair, we trade all the time, and exotic pair only if the fundamental, if there's a fundamental situation that is exception, okay? The rest of the time, we do not trade them and we don't look at them. It's going to be the fundamental that's going to give us the opportunity for the exotic pair. So very simple, okay? What is a pip? If you're here and you don't know what is a pip, you're in the wrong place. So I'm not going to explain that. What is a lot? We already know that. Leverage, pretty simple as well. Buy, sell, limit orders. All right, okay? So finished for the introduction, okay? Very simple, basic stuff. Now let's get to the real meat, okay? Let's get to the trading plan. So the trading plan is going to be your way of trading, your way of working, is going to be your Bible from now on. And you should not, divert from it. And that's how you should trade, okay? So before we begin, very, very important, okay? It will take you usually 1 to 10 days, might be more, okay? Might be more than 10 days, but usually it's gonna be 1 to 10 days to go through the trading plan and find the right opportunity. Okay, so it takes time to create a trade. You're not going to make 10 trades per day, five trades per day, because those trades are low quality. There's not 10 good opportunities on the market every day, right? So it takes time to go through the trading plan, go through the whole process, filter that information, filter the chart, and find that good 1, 2, 3 setup. Okay, it takes time. However, when you find the trade can last multiple days, multiple weeks, multiple months. Okay, let's say it takes you 1 week to find a trade. For 1 week, you don't trade. You just look at your chart, look at your fundamental, do your whole work. And at the end, you find your trade. Your trade might be good for 2 weeks, 3 weeks, 5 days, maybe 1 month. It depends. Okay, but your trade is going to be valid for a long period of time. Does it mean that you're going to keep your trade for 1 month? No. But if your trade is valid for 1 month, you can make a trade. Let's say in 3-4 days, you exit the trade. Then maybe you find another technical entry and you re-enter in the same trade later on for another, let's say 150 pips, then you exit. And then maybe in that month that your trade was valid, maybe you made 4 trades, okay? You had 4 entries, 4 exits. And basically, you can enter, exit, but your trade is valid during that period of time. You just find that good entry point and that good exit point, okay? So that's how you should view the market. That should be your vision with your trading. Okay, why do we work like that? I should say, why do I work like that? Is because you're only going to take triple A quality trades, okay, that have high probability setup. So your probability of succeeding the trade is going to be higher than if you take 10 trades or 15 trades per day. Okay, and your risk is going to be very low because you make little transactions, you don't do many trades. However, your trades are pretty large, they're pretty big, so you make a lot of pips. You have good risk rewards, you have a lot of pips that are made, and usually that's the best way to compound and grow an account. Okay, you can do it over time, you can make a lot of pips, your risk is low, you have quality trades, and yeah, that's pretty much it. So it's a positive on every aspect. You must go through the 4 pillars on every trade you make. So the 4 pillars is the 4 sections of our trading plans that we're going to see. Do not skip the trading plan. Errors happen when you do. Okay, so never skip, of course. Exception is when there is a major news event and you must react on the moment. Okay, so like I said, maybe in the beginning, in your first 2 years after this course, you're going to follow the trading plan like a Bible and really respect it 100%. But when you're going to have more experience, sometimes you're going to be a bit more flexible. And of course, when there's a major news event, something that is unexpected, something that defies all the rules of trading, all the rules of the trading plan, you can and you must react on the moment. Okay, so don't be stuck with the trading plan, forever. If you have experience, you can start to be flexible because what's good, what's bad, how you should react on this event, on this moment, and that comes with experience. It's very logical. Okay, so most of the time, trading plan must be respected, but with experience. And if a major news event happens, you can be flexible and you can react on the moment on your own judgment, because you already proved yourself as a good trader. You have good results, so you can trust yourself. You can trust, your adjustment of the situation. Okay. Of course, there is no such thing as a perfect trade. Market conditions change all the time. We have seen that this year. Okay, so you must be prepared to be flexible and adapt your plan with the market. And of course, this will come with experience. And you will see, I will repeat it, the whole weekend, the whole course. Experience. Okay, trading is not a hobby, it's not a way of making a lot of money easily and quickly. Okay, it's a skill set, it's an art that you must work on, that you must practice, that you must fail, that you must do bad trades, that you must learn from, and that you build your experience so that you can really understand the market, make the proper trade, and then you will become a good trader. So the key word is always experience. And sadly, most of the people that start trading, they don't make it long enough to build enough experience to be profitable. Okay, so be patient and see it as a long-term investment. Build your experience and you will become a good trader. All right, so let's start with the first pillar. Okay, number 1, fundamental analysis, which is about 40% of our fundamental for the trading plan, I would say. So fundamental analysis is the study of the overall state of a certain economy. We also look at the social and political news that could influence a currency. So we have 6 steps to follow. Okay, so number 1, we're going to verify the economic calendar. Then study and understand the economic data. Read, analyze, research the different news sites to know what's going on in the world. Understand the macroeconomics of the countries you're looking to trade its currencies. Okay, so the currencies that we're going to trade, we're going to look at the respective countries and understand what's going on and what news is more important, what affects the currency more basically. And then 5, create your fundamental idea, which is the most important part. Okay, you need to have an idea. You need to understand why you are going to enter in the trade. Okay, the price of a currency doesn't go up or go down just by chance for no reason. There's always a reason. So you need to have that idea and that reason based on facts that you collected previously. And lastly, you need to update your fundamental idea every couple of days or when a major news event occurs. And of course, never neglect this, because sometimes you're going to have a good fundamental idea, but the situation is going to change over the next few days. Maybe there's some updates, maybe there's some new information. So it's very important that you update it and you don't get comfortable with your fundamental idea, that you keep it sharp and you see, how you can update, refine, even enhance your fundamental idea over the information of the next couple days. So that's for the fundamental part. Now, the second pillar is going to be the market sentiment. So that's going to be 25% of importance in our trading plan. And what is market sentiment? This is how financial institutions and retail traders position themselves in the market. And usually, as a rule of thumb, they are going to be against each other. So to be a good trader, to be a proper trader, you need to understand what, who are the players of the market and what are they doing on every trade that you're making. If you understand, where everyone is and what are they doing, you can, predict what's the next move, and it's going to help you a lot to make your trades. Okay, and this part, the market sentiment, we are going to see it today, later on, but this is very, very, very abstract. Okay, this is the pillar, the section of the whole trading, course, or even trading in general, that is going to require the most experience and the most chart time. Okay, this is going to take you at least 2 to 4 years minimum to really, really, really understand it. Okay, to really look at the chart, see how the price moves. A certain time of day, some things happen, and really, connect all the pieces of the puzzle and understand how are the institutions positioning themselves, how the retail traders are positioning themselves, and basically, understand the whole relationship between the two players. Okay, so take your time. It's very abstract. If you don't understand it perfectly at first, it's perfectly normal. Okay, you should have a good idea, but once again, experience and time will do the work. So why 90% of retail traders are losing 90% of their money in less than 90 days? There's a reasoning for it. We're going to look at it later on. What's the difference between a retail trader and an institutional trader, right? What's the difference? What's the relationship between the two, between the retail and institutions? How does Forex work? What are the rules of the game? What is the basic unchangeable mechanism of the market? So basically, the financial institutions and the retail traders, they have some rules to follow. Okay, so the rules of the game, and they cannot do what they want at any time without just no reason and breaking the rules. There is some rules to follow, and you can use these rules in a trading situation and say, well, this possibility is impossible, because that means that the rule of the game would be broken. And then you can, just remove, let's say, a possibility. And sometimes there's only going to be another possibility. So you're going to have almost a certainty that this trade is going to do this or that this situation is going to happen. How should you position yourself in the market? And what's the difference between a loser and a winner in the market? If you're here today, maybe you're a profitable trader, but I think most of you guys are either, unprofitable or break even, or, you're not too sure. And sometimes you guys have good months, sometimes you have bad months. Okay, but what's really the difference between a winner and a loser? What should you do to go from one side to the other? okay? And there's actually just one thing that's the difference between the two, and we're going to see it later on. All right, so third pillar, number 3, price action, 10%. So you see this is the less important section of our trading plan, okay? So fundamental was 40%, market sentiment was 25%, and price action is 10%. So the price action is a trading technique that allows you to understand where the price wants to go by studying the candlesticks. So by looking at the candlesticks, at the chart, basically, you can learn how are the big financial institutions positioning themselves, right? What are they doing? What are the buyers and sellers doing? What is the story behind the chart? Do we want to break or bounce the element of structure? Could be a trend line, could be a resistance, could be a triangle, could be anything. Should I wait for a candlestick confirmation, candlestick pattern? Maybe. Okay, so pretty simple section. That's going to be tomorrow. So the third pillar and the fourth pillar is going to be tomorrow. So fourth section, technical analysis, which is 25%. Okay, so if you notice something here, the technical analysis section is as important as the I would say, market sentiment section. The technical, for most of the retail traders, is the number one, is the most important part, and that's where they put the most time and the most focus on. But if you see correctly here, the proportion of the importance of the numbers in the trading plan, the technical analysis is the same, has the same importance as the market sentiment. The fundamental is more important, and the price action is less important. Okay, so don't put all your focus and all your energy on the technical analysis. You should put the same work on your market sentiment and even more work on your fundamental. Okay, so what is technical analysis? What is the right definition for it? Is to find the best price for you to enter the trade, to execute your fundamental idea, and to optimize your trade, okay? So the best price to enter the trade. Does it say where the price is going to go? No, I need to know that already beforehand, okay? How do I know that before? With my fundamental idea. So the technical is going to be the execution of the fundamental idea, finding the best price, the best entry point to make as many pips as possible. And lastly, to optimize your trade. What do I mean by optimize your trade? Is to have the best stop loss, that you risk the less amount of pips as possible, that you optimize your trade with your take profit, that you can make as many pips as this fundamental idea gives you, and of course to add position. So if you can add 1, 2, 3 position on a nice trade, on a nice swing trade, you can optimize your trade by making, of course, more pips with the same movement. Okay, so you want to squeeze every little drop of pip from the market, from a solid fundamental idea that is based on facts, based on real life events, real data, some things, some stuff that are happening and not just in your head, not based on interpretation and facts, basically. Okay, and it's always the last step. All right. So in the technical analysis, there are going to be 4 sections. So you're going to have the market structure, which is like, I would say, the groundwork, the foundation of your technical analysis. Okay. Then after the market structure, you're going to have the market trend, which is really going to be the biggest work of technical analysis. This is where you're going to dissect the chart and really find that good entry price, that place where you should enter the trade and execute that fundamental idea. Then you're going to have your Fibonacci, okay, which is going to be for mostly the stop loss and the take profit. Okay, so Fibonacci's, we're going to see that tomorrow, different levels of Fibonacci, and basically their importance in terms of finding the best stop loss, the best take profit, to optimize your trade, okay? And also to have extra confirmation for your entry point. And then lastly, the divergence is going to be the last verification, the last confirmation, making sure that there's no mistakes in your technical analysis, and basically is going to give you the, you know, the green light to make your trade. All right. And that's it for the trading plan. Okay. So warning, very important, last important part of our trading plan. The importance of each section of the trading plan will vary with the market condition. The plan is not stiff. You should adjust it and adapt to when conditions change. So the numbers that we saw just right now on the trading plan, the 40%, the 25%, the 10%, and the 25%, those are like the default setting. So in a regular market, you know, very smooth, nothing crazy is going on. Those are the, you know, importance and the ratios you should respect when you look at your trading plan. However, you see that the market conditions change all the time. Just look at this year. We have, you know, the whole pandemic going on. Of course, you know, those numbers, those proportions, that importance on each section of the trading plan is going to change because, well, of course, the situation has changed. So the plan is not stiff, and it's your job as a retail trader, as a Forex trader, to really understand the market condition and adjust, adapt your trading plan, okay? Not the content of the trading plan, but the importance of each section to the market condition, okay? It's your job to you know, notice that and make the adjustment depending on what's going on. So let's do, you know, a quick example. So let's say there's nothing going on fundamentally, and or it is very difficult to create a fundamental idea, okay? Since the information you're reading is mixed. So you're reading, you're trying to build a fundamental idea, you're trying to understand what is going on, what, you know, the currencies, you know, are doing, what's the situation with the fundamental, and either nothing is going on or you're reading mixed information, okay? What do you do in that case? There's a simple solution. The fundamental section of your trading plan will be less important, and you should put more emphasis on the technical analysis. So for example, the fundamental, instead of being 40%, maybe it's going to go down to 10%, or might be 20%, or might be 30%. That's up to you to judge, okay? And the technical, instead of being 25% and being the execution of your fundamental idea, might be the opposite. Maybe the 25% is now going to go to 55%, and now there's a switch between the two. Maybe you're going to follow more the technical, okay, because there's not enough fundamental information or too many contradictions for the fundamental to take shape and take life in the market. So you're going to put more focus on the technical, and you're going to base more your trades on that, as well the market sentiment and the price action, okay? So this is also valid other way around and applicable to every section of the plan. So sometimes if there's a, you know, really important fundamental events, fundamental action, maybe the 40%, instead of being 40%, it might become 70%, okay? And the technical, instead of being 25, it's going to become, let's say, I don't know, 10%. And the market sentiment is going to shift a bit more, and the price action is going to change a bit more, okay? So the numbers, they always play around depending on the market sentiment, okay? And that, of course, like I said, comes with experience. The more time you put in the market, the more trades you do, the more mistakes you do, the more good trade you do, the more experience you have, the more you understand this concept, the better you are with adjusting your numbers, understanding the market you know, situation. The better trader you become, the more profitable you become, and you're able to grow your account, okay? So it's a chain of event, and that's how it should be. And like I said, that's it for the trading plan, okay? So do we have any questions for that section? Okay, so you can use the chat right now and ask if you have any questions regarding that. Do you recommend to journal our trades? Absolutely. We are going to talk about that tomorrow at the end of the course. But yes, all these steps are only for minor pairs, right? What we are going to trade the minor pairs, right? But in any case, even if you decide to trade the major pairs because you want to, whatever the reason, it's applicable to anything, to any market, to everything. This is universal and it applies to everything. Where do we check economic data and macroeconomics? We're going to look at that today. So, be patient. So today we are talking about fundamentals and market sentiment, and tomorrow is price action and technical assist. That is correct. With the coronavirus situation this year, how important were fundamentals? How did you shift the percentage of importance? Well, of course, at the beginning, I would say that was like 75, 80% importance was on the fundamental. But now that it's pretty much the same story every day and nothing really is going on, I would say the shift has been more to the technical and the market sentiment. I would say these last few weeks. Okay. So I think that's it for the questions. Let's continue for our trading rules. Just one last question. Do you think that we can also apply to these indexes? You can apply it to everything on every market. You can trade Tesla if you want. You can trade Apple if you want. You can trade US 30. You can trade gold. You can trade oil. You can trade coffee bean. You can beans. You can trade orange juice. It's universal. Okay. In the course, I'm going to show, I'm going to talk about Forex. I'm going to show, what's the best way to trade the Forex market, but use your head and you can apply these concepts to everything. So yeah, trading rules by me, Apex Paragon. Okay. So trading rules, why are they here? Okay. They're here for only one reason. You should never lose a majority or all of your capital. Okay. So if you follow the trading rules, if you follow this list, you should never be in a position where you blow your account. Okay. And I would assume that at least half of you guys have blown an account. Okay. Maybe a demo account or a live account, and it's because you probably did not respect any of these rules. Okay. And I think it's important to at least blow one account in your life. Could be live or demo, it doesn't matter, but just to get that feeling. And basically you should never want to live that experience again, and it will make the trading rules way more valuable, I would say. In the beginning, you might disregard it and, want to risk more, don't follow the rules, and, to grow faster, to advance faster. Okay. But when you live that experience, okay, it's important. Then you see why they are there, the trading rules. Okay. So number one, always risk between 1 to 3% of your account per trade. Recommendation is 2%. Okay, 2% is good number to grow your account, but not enough to take too much risk. Okay, how are we going to risk between 1 to 3%? Listen very carefully. Okay, this is very important. You're going to risk 1% of your account per slice of 50 pips in the market. All right. So 1% per 50 pips. So let's say you have $10,000 in your trading account. If you're not taking notes right now, you should, okay? Because I'm not going to repeat it. So let's say you have $10,000 in your account. 1% risk is $100. So basically you want to risk $100 every time the market moves 50 pips. So how many lots is that going to be? That's going to be 0.2 lot. And you are going to have a fixed lot. Okay, fixed lot, which means that on every trade you make on any currencies, even if there's slight variation on every currencies because of the currency exchange rate, you're still going to get the same fixed lot. So basically, if you have a $10,000 account, you're always going to trade 0.2 lot on every trade you make. And then when you are going to get, let's say, to 20,000, you can update it as you wish. You can, update it every, every 1,000 you make. You can update it every 5,000, every 10,000. That's up to you. But for the example here, let's say you wanted to trade 0.2 lot until 20,000. At 20,000, you do a refresh. So the 1% is now worth $200. And now your lot size, it's not going to be 0.2, it's going to be 0.4 lot. So now every trade you're going to make is going to be 0.4 lot. This also means that since your maximum risk is 3%, the maximum pips of your stop loss can be between 1 to 150 pips. Because if you risk 150 pips, it's basically 3%, right? So here you can only lose $200 times, 3, if it's 3%. You can only lose, let's say, $600 on that 20,000. And if it was at 10,000, it would be, maximum, let's say, $300. Okay, and that's how you will trade. Okay, basically. Does it mean that you choose how to put your stop loss? No. You're going to, it's not you that's going to decide where to put your stop loss. When we are going to look at the technical analysis tomorrow, we're going to look at the Fibonacci, and the Fibonacci is going to tell us where to put our stop loss. However, that trade must have a stop loss between between 1 and 150 pips. Let's say you do your technical analysis and your charts tell you to put a stop loss of 210 pips. Okay, it's more than 150 pips. Now you're risking 4 point something percent. That's more than your 3%. Okay, so in that case, you have two choices. Either the stop loss is too big and you decide, it's not worth it. I'm going to skip the trade. I'm going to wait for the next one. Okay, or you lower your risk. Okay, so to make the cut, let's say you have a stop loss, okay, of 200 pips. Actually, let's make it simple. Let's say you have a stop loss of 300 pips. You have two choices. Either you just don't do the trade and you skip it because it's not worth it, or you lower your risk. Instead of doing 1% per 50 pips, you say, if I do that, I'm going to risk 6%. That's too much. So instead, what I'm going to do is I'm going to risk 0.5% per 50 pips. Okay? So the risk is going to be the same. If you risked 1%, it would be 6% risk. But because you lowered your risk is going to be 3%. Okay, so your lot size is going to be smaller. Okay, but if you have a stop loss of 300 pips, you should have a pretty big take profit. So it's going to compensate. Okay, so that choice is up to you. You either don't make the trade if the trade is more than 150 pips of stop loss, or you just lower your risk. You just change the proportion. These are just mathematics to follow that 1 to 3% risk that you should follow. Okay, so note that, because I'm not going to repeat it, but it should be clear. It's pretty simple. So that was number one. Number two, make sure you always have a minimum risk reward of 2 for 1 or more. You always want to make sure that you make twice as many pips as you risk, of course. Never make more than 4 trades per week. Trading ideas, not position. You can have 10 position if you want, but maybe you just made 3 trades, right? Why we don't want to make more than 4 trades per week? For 2 reasons. Number one, usually there is not going to be more than 4 good opportunities in a week, okay? And also just to minimize your risk, okay? If you make 20 trades per week, you're risking 1 to 3% times 20, right? So in a week, you risk between 20 to 60% of your account. What happens if you have a losing streak? You just lost 20 to 60% of your account in one single week. Maybe it was just a bad week, right? You don't want to lose, half your account on a bad week. So you don't want to make 20 trades in a week, right? If you make 1 trade, 2 trades, 3 trades, 4 trades maximum, usually, personally, I would make maybe 1, 2, 3 trades per week. And you risk 1 to 3%, you might lose, 2%, 3%, 5% at the end of the week. It's not, fatal. You can, make up for it the next week or the week afterwards. Okay. Never have more than 2 trades. Once again, trading ideas, not positions. You can have multiple positions per trade running at the same time. Okay. Why? Just because we don't want to, be too distracted. You don't want to have too many trades running at the same time because you cannot follow them properly. So usually I would limit myself to 2 trades at the same time running. Okay. And of course, focus on quality and not quantity. Do not take partial opportunities in the market. If there's no opportunity, do not trade at all. That's it. Don't trade if there's no trade to be made. Okay. You might look at the chart all week, might look at your fundamental all week, and basically don't find any trade. Let's say it's a week that's the volatility is low or nothing is going on. There's no good opportunity. Don't force yourself to take a partial opportunity, right? To make a bad trade. Don't lower your quality standards for you to feel good about yourself, feel productive that week, and hopefully hope that you make some money, right? Trading is not a 9-to-5 job. You're not paid by how much time you put in front of the chart or if you trade 1 week or not. You're rewarded on the quality of your work, and every trade is different. You can trade 3 months per year, and the rest of the 9 months you can go on vacation, and the next year do the same thing. Or you can trade 9 months and go 3 months on vacation. It doesn't matter. What matters is the quality of your trade. So don't take your trading as a job and don't look at it week by week. Sometimes you're going to be making 3 good trades in a week. The next week you're going to be making maybe 1 good trade. The next week you might do 0 trades. The week afterwards, man, once again, no trade. Oh, the next week afterwards, 4 good trades makes up for the 2 weeks that you didn't do anything, right? So that's how you should see it. It's not regular. It's not, constant, the number of trades that you're going to do per week. It's going to vary, every time. So once again, let's continue our trading rules. Do not re-enter on a losing trade. So you just lost a trade, for example, then maybe the trade is another technical place. You might have that, revenge trading instinct in you. You want to re-enter on that trade. Forget about it. Just, take the loss, move onto a new fundamental idea on a new trade. Don't re-enter the same losing trade. Do not add on a losing trade. Okay, if you're losing a trade, don't add a position while you are in a drawdown or a negative situation, because you're just going to create a bigger loss, basically. Okay, but if you look here, may be allowed if you have a lot of experience. If you've been trading for 4, 5, 6 years, you're a good trader. You have a trading account of 500,000, 1 million and more. You started with 10,000, 20,000. You made 10,000, 20, 30,000 pips in the 4 or 5 years. You have proved yourself as a good trader. Then you can sometimes, with your own experience, add a position on a losing trade. Okay, but at that moment, you should already know that you should have enough experience to understand all the concepts. Always make sure your trading journal is up to date. Don't be lazy. It's very important to write down all your trades. We're gonna talk about it a bit later on tomorrow, actually. And yeah, very important to keep it up to date. Write every trade that you do. Why? The fundamental explanation, the technical, do the review at the end. Did you win it? Did you lose it? What's the mistake you did? And learn from your good trades and learn from your bad trades, of course. And now, last one, okay? This one is optional depending on yourself. So, everyone here should look at themselves in the mirror, be honest with themselves, and, see if this rule could apply to you. If you lose 2 consecutive trades on your live account, you must go back to your demo account and win 2 consecutive trades to be allowed to go back to your live account, okay? So it's a pretty special rule, okay? And I created this rule just to break, the losing streaks. If you have 2 consecutive trades that you lost on your live account and you go back to your demo account, it prevents you from going from 2 to 6 consecutive trades, or maybe 8 consecutive losses in a row if you're in a bad state of mind. Okay, so be honest with yourself. If you know that you have a tendency of being affected by your losses, that either you get emotional, you get aggressive with the market, you start to doubt yourself, you don't see the market as sharply and as accurately as you should, go back to your demo account, win those 2 consecutive trades, okay, get that confidence back, get that emotional stability back, and then go back to your live account, right? There's going to be infinite opportunities on the market. So even if you make 2 good trades on your demo account, okay, see it as an investment in yourself, in your mental health as a trader, let's say. And when you get back to the market, you're probably going to continue that winning streak, and maybe do 3, 4, 5, 6 good consecutive wins on your live account. Okay, but if you stayed on your live account after those 2 losses, maybe you would have continued those 2 losses because you're not in the same state of mind. Okay, so once again, if you don't see the purpose of this rule for you, if you know that you're someone that is solid, you have enough experience, you have enough emotional stability, you don't have to respect it. But if you're honest with yourself and this could be useful for you, use it, and you will see a big difference in your trading. And that's it for the trading rules. So is there any questions regarding that? What if you lose 2 consecutive and then go to your demo where you win 2, but when you go back to your live, then you lose 2 more? Do it again, go back to your demo, understand why you had those 4 losses. Is it just bad luck? Is it, you're being too cocky when you won those 2 demo trades? Find the reason why, figure it out on your demo account, and then go back to your life. When you said no more than 2 trades at the same time, what did you mean by trading ideas? Okay, by trading ideas, I mean, like, let's say you have a trade running on GBP JPY and you have a trade running on Euro AUD. Okay, those are 2 trading ideas. However, you might have 5 position on GJ and you might have 3 position on EA, for example. So you have 8 total position, but you have 2 trading idea, 2 trades. So adding a position to a fundamental idea considered as another trade? No, it's just another position, but it's the same trade because it's the same direction, it's the same analysis, it's the same everything. Do you have some ratio with compounding to withdrawals from account? What are your thoughts? I would say withdrawals are very personal to everyone. It depends. It's up to you. But as much as possible, you should let your account grow. Okay, and basically in the beginning, do as less withdrawals as you can. You want to compound that account, and the money that you deposit in your trading account, you should forget about it. You should not need it to pay your bills or anything, and you should let that that account compound and grow over 1 year, 2 years, 3 years. And when you feel that you have achieved a good amount, you want to reward yourself, you want to treat yourself for something, for your good work, you can do some withdrawals. Okay. Isn't it too risky to have that many positions on a single idea? No, because you're going to adjust your stop loss every time, right? Your risk is always going to be between 1% and 3%, even if you have 15 positions. I made a trade on gold, I think it was about 1 month ago. I had like 26 positions on the trade. What was my risk? Was it 26 times 3%? Of course not. Okay, my risk was like, well, the stop loss was moved to in profit, so there was no risk at all. But in any case, even if I decided to take a bit of risk, those 26 positions would have between 1% to 3% risk in total, because you would adjust your stop losses in proportion to your positions. How do you follow your rules? Like, how do you control yourself? Well, that's self-discipline. You have to learn how to control yourself. There's no secret for that. It's just basically be disciplined. Adding trades on winning trades. Of course, you're going to add position on winning trades. What is your opinion on prop firm like FTMO? I see many people doing it. It looks good. So there's no, if it's a way to get some capital, there's no negativity about that. There's nothing wrong with that. We're going to see during the course segment of psychology, and all the trading helps for that. Maybe you have other advices on the subject. Tomorrow at the end of the course, okay, we're going to take some time, answer some questions. But if you guys want to talk about psychology, you can ask your questions and I can give you my insight and experience. Will you teach us how to open multiple positions in a trade? Of course. Okay, we're going to see that tomorrow. Okay, guys, just one thing. When you ask your questions at the end of the sections, keep it about the section we just saw. Okay, don't ask me a question about tomorrow or something that we didn't see. Usually all your questions are going to be answered by themselves during the course. Okay, so next time we're gonna talk about the questions. You guys are gonna ask a question. I'm just gonna answer the ones that are relevant to the section we just did. All right, so let's continue. All right, so let's get into our first pillar, the fundamental analysis. All right, so let's start with the economic calendar, which is about 30% of our fundamental analysis section. So the economic calendar covers all the important fundamental events and releases that affects the forex market, of course. You can see how a particular sector of the economy of a country is doing. This information will help you structure a fundamental idea. Okay, so there are multiple sites for the economic calendar. You can use any one that you want if you have a preferred one. I listed a few of them here. Me personally, I use the economic calendar on my Facebook. I find it clear, concise. I like the way the numbers are displayed, but that's just personal preference. You can use any economic calendar. They're pretty much all the same. So this is what an economic calendar looks like if you never saw one. Okay, so the first thing you do when you open your economic calendar is you're going to change the settings. Okay, first of all, you're going to add every major and minor currency. We're not going to look at the exotics, and even if we don't trade a major, we're still going to look at them as a reference, like I said. So that's number one. And then number two, okay, you're going to select only the medium and high impact news. Okay, so the medium and the high impact news, you're going to see in the settings, you just select them, and you're just going to have them displayed on your economic calendar. You also have the the low impact news. They are usually green. Green means low impact. We don't care about them. They're not really important. Okay, so if you look at the economic calendar, here you have the date of the release of the news. Okay, you have the currency, the country, you have the name of the news, you have the impacts, and then you have the numbers. All right, so if we continue, let's see those three numbers. Okay, so three numbers. You have the previous, you have the consensus, you have the actual. Okay, the previous will be the previous result from the last data, usually would be last month. Okay, so that's the previous result. So if this one came out in July, that would be the result of June. Okay, number two would be the consensus, which is a general agreement, a prediction from the analysis. Those are the expectations. That's not the real number that came out about, let's say, the unemployment rate. Those are only predictions, consensus, before the number is released. And then number three, the last one here, this is the actual. So the actual is the real actual number that is released at the announced date and hour. This is the real number. So the 4% that you see here came out on July 6th at 8:30 a.m. Okay, this was the previous month, and this was the prediction. And as you can see, the actual number that came out is not the same as the previous month, and is not the same as the consensus as the prediction. So of course, the market is going to have a reaction to that. And our goal is to understand, depending on the numbers here, how is the market going to react, what's going on, and how can we use that to our advantage to make a trade or to collect some information to make another trade later on. Doesn't mean that you need to trade the economic calendar, the news here. Okay, it means sometimes that you just need to collect some information for later on. When you click on the news, the cool thing about my Facebook, not every economic calendar website has that. You have a description of what is the news. So unemployment rate is pretty simple, but sometimes you have some stuff that a bit more complex if you never looked at the economic calendar. Okay, and you also have here the calendar chart, the historical calendar chart, which is this whole thing here. Okay, and those are the last 10 years of data that came out about the unemployment rate. So basically from 2007 to 2018 at the moment of this screenshot. Now it's up to 2020, of course. You have every time the unemployment rate data has been released. Okay, you see all the purple dots. Those are the consensus, so it's the middle number, and the blue dots are the actual, which is the last number here. Okay, and you see sometimes they are very close together. like here. Sometimes they are very spaced out. Here they are very closed. Here we have some space. And basically when you see them that they are, there's some space between the purple and the blue point, that means that the numbers here and here are very different. So that means that the market usually will have, some sort of reaction. When it's the same, like this, usually the market has been expecting that number, so the reaction is going to be, less big and less grand, let's say. When you have big differences like here or here, you're going to have some good reactions, and those are the types of situation we are looking for. Okay, so this is, let's say, just to make it simple, these types of situations are honestly really boring, nothing is going on, and this is very exciting for the market. Some things are going on, some information is to be collected, some trades are to be made. All right, so now let's try to understand when the actual number is released. So basically, the third number here, the last one, when it's released, how is the market going to react? How is it going to move depending on, the situation, the numbers, everything? Okay, so we're going to analyze that. Right now, we're going to analyze the economic data. So those three numbers are the economic data. We need to understand what's the relationship between them and how is the market going to move. So when the actual number is released, the market will react in two parts, always, and each one has a complete different personality. So part one, I just called it the storm. You can call it whatever you want, but part one is going to start. Okay, so the duration is going to start as soon as the actual is released. And when I say as soon, I mean to the millisecond, as soon as the number comes out. So if the number comes out at 8:30 a.m., it starts at 8:30 a.m., not at 8:31, not 8:32. It's really as soon as the actual is released. And it will last until a few minutes afterwards. Could be 5, could be 30 minutes. It depends on the news, but it's not going to be hours. It's going to be minutes. What are the characteristics of that first part? The market is very impulsive, emotional, and under the effect of surprise. Okay? Who is trading during those few seconds, those few minutes? There are going to be bots, robots, from financial institutions, hedge funds, and of course, noob retail traders. Why do I say noob retail traders? I just said that the market is impulsive, emotional, and under the effect of surprise. A professional trader doesn't trade in a market like that. It's too imprevisible, and the probability of doing a mistake is very, very high. Okay? I would assume that you've all witnessed, an economic data release, and you see how fast the candle starts to move. As you don't even have the time to look at the number, open your chart, and the candle has, already made 30, 40, 50 pips, sometimes 100 pips if it's something crazy. Okay, but if you try to catch that move, you're a noob retail trader, because there's no way that you're faster than a robot that is pre-programmed on top quality, internet. You're never going to be a match for them. So basically, we do not trade the part number one. Okay, we look at it, we understand what's going on. Okay, but we don't trade it. It's important to understand, but not trade it. All right. So what's going on in part one? Okay, we need to understand how the market will react. We will ask ourselves 3 questions. Number one, is the actual a surprise or not relative to the consensus? If it's a surprise, is the surprise positive or negative? And on a scale of 1 to 3, how surprisingly positive or negative is the actual? Okay, so those are the 3 questions we will ask ourselves. Let's do an example. Okay, so here I have 3.8, 3.8, and here I have 4% that came out at 8:30 July 6th about the unemployment rate. So the first question is the actual, the 4% that we see here, is the actual a surprise compared to the consensus? What do I mean by a surprise? Is it the same number? If it's the same number, it's not a surprise. If it's not the same number, it is a surprise. Even if it's 0.1 difference, even if the number is slightly above or slightly below, it is automatically a surprise. Okay, so in this case, yes, it's a surprise because it's not the same numbers. Then, is the surprise positive or negative? Of course, it's negative. Why? Because the unemployment rate went up, right? So you use a bit of your head to understand that concept. And then lastly, if we go back, we said on a scale of 1 to 3, how surprisingly positive or negative is the actual? So we want to know, what's the size of the impact? Is it, slightly negative, medium negative, or very negative? So 1, 2, or 3, okay? And how do we give that scale? How do we decide if it's 1, 2, or 3? We will give that score according to 3 criteria. Okay, so number 1, we will look at the importance of the news, medium or high impact. In the case here, it's a medium impact. Okay, so it's a bit less important than the high impact. Then we will look at the difference of numbers between the actual and the consensus. Is it a slight or a large difference? If I look here, I have a difference of 0.2%. All right. And then lastly, verify and compare the historic data of the last 3 to 6 months on the economic calendar to confirm criteria number 2. So basically, we just want to know if this 0.2% difference, is it like something that's normal? Is it like the usual difference that the consensus and the actual has? Or is it something that is very spectacular? Or is it something that's out of the ordinary? Okay, so that's why you will use this historic chart to look at the last 3 to 6 months that the unemployment rate numbers came out and see, what's the difference, and is this 0.2% something that's not normal? Okay, so here I took the last 4 months. This news came out in July. Here I have June, May, April, and March. Okay, and I took the numbers between those last 4 months, and we have the consensus and the actual. And we see in June we have a difference of 0.1. Okay, between 3.9 and 3.8%. In May, it was 4 and 3.9. So once again, 0.1 difference. Then in April, 4.1, 0.1% difference. In March, consensus 4, actual 4.1, 0.1% difference. So in the last 4 months, every time the unemployment rate came out, the difference between the consensus and the actual was 0.1%. It was always a slight difference. And sometimes like this, it was positive in June. Sometimes, let's say in April, it was negative. In March, it was negative too. Okay. And basically, here we have 0.2%. So is it something out of the ordinary? Yes, it's more than what we are used to receive. Okay, now is it some crazy difference? Is it 0.8% difference? No, so it's not a 3, it's not a 1, so it's not a 1, it's not a 3 on the scale. I would say it's a 2. Okay, Or even I would say, if you're really precise and you want to get really uh, precise with your numbers, instead of being a 2, I would even say it's like a 1.75 on the scale. Okay, so it's a surprise, it's negative, and I would say it's 1.75 2 of the surprisingly negative on the scale of importance. And this is going to give us the size of the movement that is going to happen during that first reaction. Okay, so that's for part 1. So in that case, here on the part 1, we will have, depending on the currency, the USD will be negative. And since we said it's, let's say, 1.75 of importance on a scale of 3, okay, we're going to have, when the news is released, we're going to have a negative reaction. So the USD is going to depreciate. Is it going to depreciate in that first reaction of a few minutes of 300 pips? Of course not, because the numbers, are not that surprising, right? Are not that surprisingly negative. So in that case of 1.75 importance with the situation that we get, I might say it would be maybe between 30 to 50 pips, okay, that the market is going to move in that first 5, 10, 15 minutes when the part 1 of that news is released, okay? If it was a 3, maybe it would have been, 150 pips, 300 pips, it really depends. If it was a 1, maybe it would be 10 pips to 30 pips, okay? It will depend really on the news, like I said, the numbers, the size of the impact. Where is the current fundamental state of the market? Is the market very sensitive? Does it react very, sensitively to, data? Is it more laid back and the economic data has less importance? All those factors should be taken in when you do that analysis. Okay, so that's for part 1. Now, part 2, okay, is the calm. So I called it the calm in contrast to the storm, which is part 1, okay? And the duration is going to be right after the end of first part. So you're going to see after the first part, there's usually a small break between 1 to 5 minutes. The price is not really moving, but then you would see part 2 kick in right after, and it will last a few hours afterwards, okay? The characteristics, the market is rational, thought out, and planned out, okay? So it's the complete opposite of part 1. Who is trading during that time? Manual traders from, institutions, hedge funds, and professional retail traders. Why? Because the market is rational, it's thought out, it's planned out, it's predictable, it's a high probability setup if you analyze everything correctly. And so manual traders are able to enter in the market at that moment. Okay. So how do we analyze part 2? We will ask ourselves once again 3 questions. And the first question is the actual versus the previous, positive or negative. So actual versus previous. If you remember in part 1 was actual versus consensus. Now it's actual versus previous. So we're not comparing the same data, okay? Because the consensus at the end of the day is a prediction, okay? It's not based on facts. It's based on how the market feels. So that's why you have that emotional reaction at first. But when we get to the second part and we compare the actual with the previous, we actually look at the facts. We look at the data from last month, okay? And that's what really is important, and that's what will last in the market, okay? Then number 2, do we arrive at the same conclusion as the first reaction in the second reaction? Are both positive, negative, or opposite? Okay. So in the first part, we said that it was surprisingly negative. In the second part, is it still negative again with the previous, or is it positive? Finally, is there a change in the numbers, or is it the same thing with the consensus or the previous? And finally, how are the financial institutions going to interpret the situation and act? Three possibilities. So what are those three possibilities? If we arrive at the same conclusion for part two as we did for part one, we will have a continuation of the first movement. So let's say part one was negative, right? And part two is negative as well. What happens? USD is negative. It will continue to depreciate. Okay, so let's say this was part one. Then we have a bit of a break, and then part two will continue. We'll have a continuation of the first movement because nothing has changed. We just have a confirmation of the first movement. Okay. Now, if there's a slight difference between part two and part one, the market will become uncertain and the price will start to start consolidating. So if there's a slight difference of number, just slight enough to make the market uncertain and to create a confusion, the market will just stop and the market will start consolidating because there's not enough to continue the movement, but there's still not enough to reverse the movement. Okay, it's a slight difference. And lastly, if part two is the complete opposite of part one, the market is going to reverse the first movement. So let's say part one, negative, we said, it's, with the example of the USD, it's going down, right? We have part one, then we have this small little break, and then we look at part two, and when we compare the actual and the previous, actually, it's the opposite, it's positive. So what will happen? The market will go right back up. It might go back to the same level here, or it might even continue a bit further depending on the numbers and the reaction of the market. Okay, so those are the three possibilities that will happen in that part two. So in the case here, it's the same example on open run rate. We will compare the actual with the previous, right? And since the numbers are the same, 3.8%, 3.8%, we already know that we are going to come up with the same conclusion, okay? This is negative, okay? And of course, here for the second part is going to be negative as well, since they are the same number, okay? So do we arrive at the same conclusion in part one and part two? Is it the same thing? Yes, it's the same thing. And the same thing is negative. So how is the market going to react? We're going to have a continuation of the first movement. So basically we have part one, small break, and basically part two. That is going to be, usually longer in period of time. So maybe that's, I don't know, 10 minutes, and maybe this one is going to be 3 hours. Okay, it depends every time, every situation is different, but that's how you know what is going to happen. So your job is to always look at the numbers, okay, here, do that whole process that we just did, and you will be able to understand and predict what is going to happen in the market even before it happens. Okay, that's how you analyze proper information. Okay, so let's do another example. Okay, this one is going to be more, I would say, complex because we have tricky numbers. Okay, so non-farm payrolls, which means the number of new jobs created, so NFP, first Friday of the month. High impact news, very important. Let's look at the data. Okay, here we have the previous, the consensus, and the actual. Let's start with part one. So basically in part one, we compare this number and this number, the actual versus the consensus. Here, is it positive or negative? Actually, is it a surprise? Yes or no? Yes, it's a surprise. Is the surprise positive or negative? It's positive, right? Because we have more jobs created than we expected, okay? And then lastly, on a scale of 1 to 3, how surprisingly positive is this number of 213K new job? We look at the high impact news. Okay, so we know it's serious business, it's a high impact news. We look at the difference between the two numbers, which is 18,000 jobs difference. And we want to know, is that 18,000 job difference, is it like a big difference? Is it something that's minimal? Is it pretty much the same, or is it a big difference? What do? We look at the historical data here on the chart, and we look at the previous months, see if 18K is something that's normal or abnormal. So here, once again, last 4 months, you could take 3 months, you could take 6 months. Honestly, it's up to you. And June, we have 188 to 23, okay? So that's a difference of 23 plus 12, so 35K difference right over here. Then here, 192K, 164, which is a difference of, I don't know, because I can't compute those numbers right now, but it's way more than 18,000. Let's get back to it a bit later. Here it's pretty simple, 193, 103K, so that's a difference of 90K, okay? And in March, 200K versus 313K, that's 113K. And this is something, I don't know if someone can do the math. I can't teach a course and do the math. 28, thank you, Michael. So 35, 28, 100, actually 90 here. 90 and 113K. So you look then at that 18K and you compare it to those differences in the last 4 months. Does it look like a big difference? Absolutely not. Okay, it's a very small difference. Usually the numbers are way, way bigger. Okay, so in that case, in a scale of 1 to 3, how surprisingly positive is this news? I would say it's a 1. So slight positive. So what will happen? The market will do a slight baby move. Since it's NFP, maybe like, and it's a high impact news, might be a bit more. So maybe like, I don't know, 20, 40 pips, something like that, very small. And those few minutes, nothing too crazy, just a small move, okay? And then we get to part 2. So part 2, okay, we compare the actual, but with the previous this time, okay? And we look to see if it's positive or negative. In this case, it's negative. We have less new job created than the previous month. So it's negative. Part 2 is negative. Part 1 was positive, part 2 negative. So do we arrive at the same conclusion in part 1 and part 2? So is part 1 equal to part 2? And the answer is no. One is positive, the other one is negative. Okay. What's the difference in number? Here it's 10K difference. So it's even less than the small difference in the first part. Okay. So the last question we have to ask ourselves is, how is the market going to react? How are the traders going to trade this information? And we have 3 choices. So either a continuation, either a consolidation if there's a slight difference, or if there's going to be a reversal if the numbers are the opposite. In this case, it's a slight difference. So this one is slightly positive and this one is slightly negative. The difference between all these numbers is 28 thousand, okay, which is the same as the difference in May between the consensus and actual, and this is the difference between the actual, consensus, and previous. So very slight difference, not enough to create a move, not enough. Of course, it's not going to be a continuation because it's negative, the second part, but it's not enough to create a reversal of that first positive move here that was 20, 40 pips. So what will happen? It will be a bit of consolidation. Consolidation. And basically the market is going to be flat. Nothing is going on. So the big conclusion, the result on your chart, what you will see is small move up, bit of consolidation before part two, and then part two is slightly negative, so you might see a small dip, but then it's going to do this, and that's part two. Okay, so nothing going on. Can we trade these types of movement? Not really, because there's no movement, there's no direction, and basically there's nothing to trade. Okay, so in this case, that's not a scenario that is interesting to us because nothing is really going on. And you see this whole process that I did, part one, part two. Now you are learning about it, so it might take you like 5 minutes to analyze the numbers. But let's say in 1 year, when you have done this, let's say 1,000 times, you just look at the numbers, and in about 5 to 10 seconds, you already know everything that's going on. You get from those numbers to the results in less than 5-10 seconds because it's very easy to do the process. Okay, and you know directly if it's a good situation to make a trade or not, and is it a good situation to take some information or not. Okay, in this case, since it's a consolidation, it doesn't really mean anything. There's nothing to trade. This is something that you just disregard because nothing is really going on. All right, so that's how you analyze the economic data. That's how you understand what is going on in the market. Okay, so once that is mastered, we are going to be using the economic calendar for 3 reasons. Number one, if the news is really, really, really important, which means a big movement is created, and you have experience, of course, you mastered this part, okay, you will be able to trade the second reaction, part two, okay, right after that first part one. So let's say part one, okay, you have that small pause, you have the time to analyze part two, you know what's going to happen. Let's say you have a situation where part two is the complete opposite and you have a big reversal like here. Let's say that's part two. Okay, well, in that situation you can trade it, you can find an entry point here, 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 and basically make that trade. Okay, and maybe those trades are going to be like, maybe, I don't know, 5%, 10% of your trades in a year, something like that, but those are like free trades, very easy to analyze, very easy to understand. And if the news is really, really, really important, we have a lot of movement, you're going to be making 100, 200, and 300 pips, as a gift. The market is giving you a gift since it's so easy to analyze. Okay, so that's number one. Number two, by looking at economic data, we accumulate information that will help us form our fundamental idea later on. So by analyzing the numbers, looking at everything that is going on in the economic data, you start to collect over time. Okay, let's say you have a big fundamental bag and you put ideas and information inside of it. You start to collect information about the state of a certain country. How is GBP doing? How is USD doing? How is AUD doing? How is NZD doing? Okay, and basically this information is going to build up over a few weeks, few months of looking at the economic data on different sectors of the economy. You can, at the end of each week, you can write them down, basically the recap of the week, the different news that came out, if it was positive, negative, give your opinion on certain like I said, sectors of the economy of a country, and later on it will help you to form your fundamental idea. Okay. And lastly, number 3, by looking at the economic calendar, we have a sense of the importance of different news, and we can protect, adjust our current trades, exit the trade, or take partial profits. So if you know a big news is coming up, the numbers, you don't know the numbers in advance, but you can expect something to happen. Basically, you're going to and you have a running trade, you can exit the trade. Let's say if you're near your take profit, you don't want to take any risk, or you can take partial profits, or if you want to wait, you want to still be in the trade, you just put your stop loss to break even. Okay, so stop loss to break even, that's the third possibility that you go to. So exit the trade, partial profit plus stop loss break even, or if you don't want to take partial profit, just stop loss break even to protect yourself in case a number comes out and the market goes crazy against you and your winning trade ends up losing. Okay, and that's it for the economic calendar. Okay, actually there's this section right here, and just last section I made a list of every news that comes out on the economic calendar. This is just like a reference list. Okay, and you will see there's a lot of news that come out on the economic calendar. And it took me a lot of time to do all of this, but basically you have the description of the news and sometimes some insights, some notes I took. On this one, I just put the website, you can look at it. They have a good description. But here you have basically the explanation of every, economical news that shows up on the economic calendar. Okay. If you don't understand a certain economic situation. So let's say, for example, I come back and let's take an example. Let's say you don't know what the Westpac consumer confidence means. Okay, you read the description, you don't really understand it, just do some research, use your head, go do some research, try to really understand it and see, is it really important for the market? Okay, and I'm not going to tell you which one is really important, which one is not important at all. I want you guys to look at the economic calendar, to study the charts, see the reactions, and basically over time build that understanding of every news and see which one should I look for, which one I don't even care about, and which ones sometimes are important and sometimes are not important. Okay, but of course I can tell you this: every time you see an interest rate decision, every time we talk about the Fed, Bank of England, Bank of Australia, whatever that has to do with the bank of a country or the interest rate, okay, that of course is going to be very, very, very important. Okay, but the rest I'm gonna let you guys figure it out. It's very important that you live it, you build your experience, and you see what's important and what's not. And that's it now for the economic calendar. So is there any questions for that section? Now is the time. Some economic data like surveys don't have a consensus. They just have a previous. How do you analyze those? Maybe a survey like that, maybe it's not really important and maybe you should not care about it. Okay, so that's a hint to your question. Do these news come out randomly or scheduled? Of course they come out scheduled. Okay, look, if I open here a economic calendar right now, all the news are scheduled. That was this week, but let's say I look for next week. Those are all the news for next week. Okay, so for example, Monday I have these news. That's Tuesday, Wednesday. So for example, on Wednesday, actually, let's take an example on Friday. Okay, so let's say Friday at 2 p.m. here. 2 a.m. actually. Retail sales for GBP is going to come out. Okay, here I have all the information, and the actual is not released yet, but I have the previous and the consensus. So depending on the actual that's going to come out, something is going to happen. Okay, so everything is scheduled in advance. When the release of some of these events collide, how do you weight them? Do you do that by experience, or is there actually a method you use to quantify the impact? What do you mean by collide? Do you mean when multiple news comes out at the same time? Yes, you will use the same system, the same things we just saw right now, but you're going to apply it to, let's say there's 3 news that comes out at the same time about GBP. You're going to, of course, the 3 news that comes out are not going to be the same importance, but yeah, you're going to weigh them depending on their importance and the reaction with the numbers. And there's no special method, that just comes with experience. What about when there's a speech in economic calendar? Do you pay attention to that? Depending on the speech, yes. I would say 90% of the time I would pay attention. Can you know what's going to happen prior to the news based on your research on the current economic state? Absolutely not. The actual never is is known, never is previsible. As a retail trader, even Goldman Sachs, even any institutional trader does not know the actual before it is released. You cannot predict. That's why you have the consensus, which is the best prediction. Sometimes they're going to have it right, but I would say most of the time, the actual is going to be something different. Slight difference, or sometimes it's going to be the opposite completely. Can you walk us through your fundamentals for the XAU trade you talked about earlier? Honestly, I don't remember the fundamental. The trade, as it was like 2.5 months ago, and it's not relevant to the course right now. If I'm looking for Euro AUD opportunities, do I have to check GBP or GPY news? Absolutely not. You're trading Euro UUD, you're looking for opportunities. Has nothing to do with GBP or GPY. So the best thing is to wait for the 2-part and see if there's an opportunity. You don't, well, yes, you wait, but you analyze part 1 and part 2 at the same time, because you have all the numbers. But yes, you would trade that part 2 if an opportunity is there. If there's no opportunity, like the last example we did on NFP, you don't trade it. But you can use that information for your fundamental idea. And of course, if you have a trade running, like I said, you can protect yourself. And I think that's it for the question. So let's continue. Okay, we are going to look at the headline news, which is the last section of fundamental analysis. And then we're going to take a lunch break, and we'll finish the rest later on. Okay, so headline news, 70% of our fundamental analysis. So what we just did before the economic calendar was 30%, remember. So we don't put 4 hours per day looking at the economic calendar, trying to analyze everything. Usually, personally, I'm going to put maybe, I don't know, 10 minutes, 15 minutes per day in total during the day, maximum, right? But the rest of the time is going to be on the headline news, which is really the meat of our fundamental analysis. Okay, so what are headline news? They are real-time Forex news of the different fundamental events worldwide. So central bank news, political problems, wars, basically any event that can affect a currency. This will be the majority of fundamental work and will be the principal tool to create our fundamental idea. This is basically our research. Okay, if we make it simply. So basically our research for the fundamental idea and basically the research for our trade. Okay. The website I use, Forex Live, which is the preferred website. Why is that? Because you have basically everything at the same place. Okay. And it's completely free, which is very nice. The BBC website news for the GBP, everything has to do with the UK, Bloomberg for the USD, that is going to affect, for example, gold or something to have some relationship with AUD, with China, with something like that. Reuters, The Guardian, Financial Times, and of course Google for some extra research. Okay. So basically, all these websites are free. Okay. If you want a premium service, okay, if you want a premium service, a premium news service, you can use Run Squawk. Okay. I don't remember how much it is per month, okay? But you have like a trading radio that you can listen while you trade, okay? And basically it's the same concept as Forex Live, okay? And you will have all your headlines on everything that's going to happen in the world that is Forex related in real time, okay? Do you need to use Run Squawk? You might ask me the question. Absolutely not. It's just a premium service, okay? But the information from Run Squawk for all these sites is exactly the same. You don't have an edge. You don't have a competitive edge with information. It's just that it's a premium website. You have the radio. You might have a bit more features, a bit more flexibility with the program, but that's it. The information is the same. All right. So Forex Live is the best website to read and research everything that is going on with the FX market. Okay, we have 4 professional analysts, and they follow every news source. So basically, those 4 analysts, okay, they are plugged. I don't remember. I read an interview. Actually, I listened to an interview with Adam, which is the founder of Forex Live, and I think it was between 50 to 70 websites that they monitor, that they read, that they look at 24/7. Okay, so they are doing the work for you. So instead of having 50 websites that you have to go through to find the headline news, to find the information, they will do it for you, and they will basically post it on the website for the stuff that is important. Okay. 24/7. Okay. Each post is a fundamental headline. There can be 50 to 200 headlines per day. At first, you will read every headline, but with time and experience, you will know what to look for and be selective in your reading. So there's 50 to 200 headline that comes out every day. What do? We read everything at first, okay? You don't know what you're looking for yet. You read everything. But with time and experience, you will be selective in your reading. So maybe on the 200 headlines, let's say me personally, maybe I'm going to read 30 headlines, okay, throughout the day. Okay, so I will look at Forex Live maybe 2, 3, 4 times per day throughout the day and read the headlines, see what's going on. Also, the must-read section are the most important news of the moment, and reading this trading session wraps every day is a must to keep yourself always updated. So let's go on Forex Live right now, and I'll show you how it works. Okay, so this is Forex Live. Okay, and you see every headline, every news every title is technically a headline news. Okay, so you can open them up. So here we have a headline on Florida coronavirus cases continue to level off at a high rate. You have some statistics, some data. Here we have a news wrap, and basically those are all the news that come out throughout the day. So for example, this was Friday. Okay, so Friday yesterday. Let's see how many headlines came out. So basically we have this whole page, which is Friday. Then this is Friday again. So this whole page is Friday. Then this is Friday once again. And Friday, and here it's Thursday. Okay, so you have pretty much like 3 pages, almost 3 pages. Yeah, 1, 2, 3, 3.5 pages of headlines in one single day. At first, like I said, you're going to click on all of them. You're gonna open every one of them. Okay, so you can open this one, you're gonna read it. You're gonna try to understand what it means. Is it relevant? Is it useful for my trading? If the answer is not, then you disregard it. Then you click on this one, for example. You read it. Is it important for my currencies? Is it important for my trading? Does it give me an insight? Does it give me an edge? Does it give me some information about what's going on with this currency? If the answer is no, you disregard it. If the answer is yes, you take note, you keep it in your head. Okay, it's going to be useful. Let's say I go back again. Let's say, for example, this one, okay? EU's Mitchell. Who is EU's Mitchell? Do some research. Charles Mitchell. Who is he? What does he have to say? Okay. With political will, an agreement is possible. An agreement about what? What's going on? There's a negotiation about what? Is it just with the EU? Is it with the GBP? Is it with the AUD? Is it with the USD? What's going on? How can I take this information and use it for my trading? Okay, that's the same thought process you will ask yourself every single headline, every single day for the rest of your trading career. Okay, and that's how you just digest and accumulate that information. So just like the example that I did before, let's say you have a fundamental bag in your hand, okay? And you take that information, you put it inside, and at the end of the day, at the end of the week, at the end of the month, you're gonna have so much information, you're gonna be able to take that, shape them, create a fundamental idea, and know exactly where a currency is going based on facts, okay? That's how you read the headline news. Like I said, also, the must reads are a section that are important, okay? Now here what I see is ads, okay? So like here, this is an ad for something, and what you need to know before trading that looks important. NVIDIA gains. Is it relevant for us? No. 3 cloud computing stocks riding the hype wave. Is it important for us? No. So maybe this one is important. I'm going to click on it. Okay. Sometimes you're going to see ads from Forex Live with other websites. They have to make money somehow, so you can't blame them since the website is free. But sometimes you're going to have some real good pieces of headlines that maybe you missed throughout the day. Okay. And then the last section on Forex Live that you need to be aware of is when you click here on more, okay, you have the session wraps. Okay. What is a session wrap is basically, it says it over here, major Forex headlines wrapped up by trading session. So throughout the day, we have, of course, New York, we have Tokyo, and we have London session. Actually, it's Tokyo first, then London, then New York at the end. And at the end of each session, they will create a big session wrap with everything that came out during that session, the most important part. And basically, you have all the headlines that are important. Okay. Then here we have European FX News Wrap. So that's London. Here they have the most important headlines, the markets, You have some description on the currencies. Okay, so basically, if let's say you miss a session because let's say you were sleeping or you were not home or whatever, when you come back to your screen, look at the session wraps to see what you have missed. All right. Or let's say you go 1 week on vacation, you didn't look at your charts, didn't look at the fundamental. When you come back, you probably missed some new information that is important for the market, right? You're lagging behind. What do? You go Forex Live, session wraps, and you read all of them, okay? You read all the last session wraps and you get back up to speed to where you should be. And then you resume to basically to your normal routine of reading the headlines. Okay, so very simple, honestly. And the more time you spend, the more you are going to understand what is going on. So what should you look for when you're reading, researching, analyzing the headline news? Okay, you must first understand that you won't understand a majority of headline at start. All right, you don't know the story, you don't know the context, you don't know what's going on. It's like if you're going to see a movie, the movie is in the middle. It's in the middle of the movie, and you're walking into the cinema, and you start to ask yourself, well, what's the story? What's going on? Who's the bad guy? Who's the good guy? What's the goal of this movie? You missed the first part. You need to get up to speed. Okay, so it will take you a few months to get up to speed, to understand what is going on, because there's a lot of information. Like I said, it takes time to become a good trader. Okay, to really digest the headline news from today, I would say 3 to 6 months. 3 to 6 months from today. Okay, so basically, let's say until the end of the year, 2021 January, you should be, very comfortable with the headline news. You should be able to know exactly what you look for, research the proper things, analyze everything, and understand everything. But until then, you will see that you will not understand everything. It takes time. Okay, the more you read, the more clear it will become logically. Your goal is to accumulate important fundamental information and put it in your fundamental bag, to grow your understanding, knowledge, and later on form your fundamental idea. Okay, so basically, on every trade you make, there needs to be a reasoning why. Okay, and that reasoning, that fundamental idea, is based on what? It's based on facts. It's based on news. It's based on events. It's based on deals. It's based on problems. It's based on solutions. It's based on real-time events, news, facts. Okay, and where do you collect? Where do you collect that information? Where is that information that you need? That really important information. Where is it? It's in the headline news. And where are the headline news? They are on Forex Live, they are on BBC, they are on Bloomberg, they are on Reuters, they are on The Guardian, they are on the Financial Times. Okay, you have to go collect it. No one is going to collect it for you. Okay, the better you are at collecting and understanding that information, the better you understand the events, the news, the facts, the better your fundamental idea is going to be, and the more and more accurate you're going to be with your trades, because you're properly going to digest that information. So maybe at first you're going to have a 50% accuracy, but the better you become with this whole process, then your profitability is going to go to 60%, and then maybe in 2 years is going to go to 75, and then maybe in 5 years is going to go to 85%, because you really know how to analyze that information, create that solid fundamental idea, understand the market, and then your probability of doing a good trade is going to rise up with time. Okay, that's the mental process. That's what's going on as a trader. Okay, So it's not, well, I have a double top here, I'm gonna short, I'm gonna make 30 pips, and let's call it a day. Yoo-hoo, I'm gonna withdraw my over risked 10 lots I opened on my $5,000 account, and I'm gonna go buy some shoes. Okay, that's that's not how it works. Okay, it's a process, it takes time, and that's how you build a skill set. You become a good trader and you grow an account over time. Okay, I hope that is very well understood. So let's continue. Now that we know the process of the headline news, we know why we are looking for them to create our fundamental idea, to make our trades. Okay, we need to get to know our currencies. Okay, the minor currencies, the major currencies, what what are their characteristics, and this information will help us better understand our headline news. Okay, so like I said, we have Tokyo, London, and New York session throughout the day. We'll also have Sydney, but it's like open 22 hours per day, so let's disregard it. So Tokyo Asian market is active. Currencies who are moving are these ones, are going to be more active. London GBP Euro CHF is going to be more active, which is the European market. And then New York USD CAD Gold is going to be moving during the American market. Okay, so simple enough. Remember that we said that we are never going to trade major pairs. Why? Because they contain the US dollar in them. In the introduction, when we talked about the currency pairs, I said we're never going to trade the USD. So why should we not trade the USD? Okay. Here are the reasons why. Okay. And basically, I'm going to go through them and we're going to summarize. The New York session is the worst one to trade because of the following reasons. The USD is extremely bipolar and the most difficult currency to predict because of all the political, economical relationship with other countries. Okay, there's too many things that are going on with the USD, with the USA, and it makes the USD extremely bipolar and very difficult to predict. Okay, there's too many elements to analyze for you to make a perfect, a good trading idea. It would take you 3 weeks to process that information, but then when you finish it in 3 weeks, the trade is already finished, and then it's onto the next one, and it takes you another 2 weeks to find that new setup, and then the trade is over. Okay, it's too difficult, it's too bipolar to analyze properly the USD to a high level. You can do a quick analysis and understand what's going on, but to really make proper trades, it's very difficult. Okay, of course, Trump, I don't need an explanation for that. Financial institutions agendas. Okay, we have a lot of big hedge funds, banks in America that have agendas with currencies outside of trading. They need to move money, have businesses moving money left, right. There's some stuff that is going on. We have options, we have futures that are very big in the US market. So sometimes you're going to have some unexpected events, unexpected movements that you did not really analyze, and you are going to wonder why, because there's a secret agenda. And USD usually is good for day trading, not swing trading, because the ideas don't last a long time. One day everything is going good, tomorrow it's hell in America. And then the next day, oh, everything is fine, and then the next day it's worse. Okay, so it's good for day-to-day trading, but swing trading over, let's say, a few days, 1 week, 2 weeks, there's too many variables, and it's very difficult to place a good swing trade. Okay, so it doesn't fit our style, and by extension, of course, it's not optimal. It's not the best way to trade. So that's why we don't trade it. If you want to trade the USD, okay, we are all adults here. I hope you can trade it if you want, and you can learn it by yourself. if you want to make, small day trades, if you want to see if you can try to figure it out. But you will see pretty quickly why I say to not trade the USD. But you can trade it if you want. Me personally, I don't. Okay. So basically, to sum it up, is too complex. USD is too complex. It's too bipolar. There's too many factors that affects its currency, and it's very unstable. So every time you put money in the market and you have these odds against you, I don't want to put my money in the market where there's, let's say, if those were all enemies. I have too many enemies in the market. I have the complexity, I have the bipolarity, there I have so many factors. It's unstable. I have Trump against me. Everything is going, against me. Maybe I don't want to trade it. I want to trade something else that is less complex, less bipolar, with less factors, with more stability. Okay, so that's the reason why we don't trade the USD. So what currency will we be trading? Minor pairs, but only a selected few. Okay, so here we have 6 currency pairs. Okay, GBP JPY, GBP AUD, GBP NZD, Euro JPY, Euro AUD, and Euro NZD. Okay, so 6 pairs. And with a lot of experience, only exception that contained USD is gold, okay, which is a commodity. Technically, it's not a currency, it's a commodity. But why I say it's advised to have more experience, because it contains the USD and has a level of complexity that is superior than these 6 pairs, okay? And you can trade other indexes if you want, okay? These days I've been, playing around with the Dow Jones. So, I've been experimenting with that, seeing what's the behavior with that. But basically indexes, commodity, you can trade oil if you want, basically everything that has to do with the USD market, except its currencies, can be managed. Okay, there's less complexity and there's more, cohesion between these types of products or financial products. But that's it. But when you start, focus on the 6 pairs, and with time, if you want to explore a bit more, you can go to this side and play with both. Okay, you see that all of those currencies are mostly moving during the Tokyo and London session. GBP, Euro, JPY, AUD, NZD. Well, that is going to be our preferred trading hours. However, you can trade any time of the day if you have a good opportunity or entry. Doesn't mean that you have to enter in Tokyo and London. Okay, you don't have to. It's just that it's preferred because they are going to move more. Okay. Why did I select these 6 pairs? In behind it, the selected pairs have little political links between them. It makes it easier to predict the fundamental, and it's more stable. This allows us to make swing trades that can last a few days to a few weeks without too much fundamental turbulence comparatively to the USD. Also, these are known to be professional traders pairs since they move a lot and obey more technical analysis. Okay, they are great to generate money. Okay, if you take GBP and you take JPY, right? What's the relationship between these 2 countries? Very small. The relationship is very small. Very rarely you're going to see a problem with these 2. Some conflict of any kind, some situation of any kind. The relationship is very little politically and very little economically. Okay, If I take, for example, the opposite, I take USD CAD, one of the worst currencies to trade, okay? The relationship is too big. The relationship, the political relationship and the economic links are too big. Even if I do my fundamental analysis, I look at my technical chart, it can be all scrapped away tomorrow if something happens here and something happened here. And the probability of something happening is very high since we have, two countries that are very linked together. If I take for example, Euro GBP, same thing, very bad. Why? They have too much political and economical links. It becomes unstable, there's too many factors. Your probability of making a mistake is higher trading this and this than trading GBP, JPY. Okay, that is the reasoning why. Okay, hope that's clear and hope you understand why that selection was made. So now, correlation between currencies and what makes each currency move fundamentally. Okay, let's start with GPY. So basically, we want to understand GPY and all the other currencies, their personality. Okay, what makes them move? Okay. JPY is inversely correlated with CNY, which is the Chinese yuan. Okay, so basically, when things are bad in Asia, okay, JPY goes up. Okay, and basically, the biggest country in Asia is going to be, let's just say, China. Okay, when China is doing badly, JPY is going to go up. Why? Because also JPY is a safe haven, is the safest currency in Asia. Okay, so that's why I said when things are bad in Asia, but mostly China, since it's the biggest country, the JPY goes up, and in that case, it's inversely correlated. JPY is a safe haven because they have a strict monetary policy. They handle their economy very seriously and safely comparatively to the other Asian countries. It's a worry-free, and when I say worry-free, it's let's say worry-free investment for investors in Asia. It's the less risky investment, let's say, for investors in China if things are bad everywhere else. So in times of crisis in Asia, JPY is going to be long. Okay, it's going to go up. And of course, monetary policy and economic data is going to play a role with JPY. JPY is going to be sensitive with that. Well, actually, the monetary policy and economic data, this whole section is going to be applied to all the currencies, basically. Monetary policy and economic data is important for JPY, AUD, NZT, GBP, USD, whatever currency, it's going to be always there. So that's it for JPY. Then AUD. What's the personality of AUD? So AUD does business mostly with China. Its economy depends on it. Okay, AUD is directly correlated with China's economy. China not doing good, AUD not doing good. Okay, China doing great, AUD is doing great. Okay, directly correlated. AUD is a big producer of gold, so when gold appreciates, it affects AUD positively, not by 90%, but let's say 25%, 20%, it's going to affect AUD. AUD little brother is NZD, so they have a relationship between the two, of course. Okay, they are, NZD is dependent on AUD. Okay, since AUD is the big brother of NZD, and of course monetary policy and economic data. Okay, so you see here we have China, then here we have JPY, and here we have AUD, and they all have a relationship between them. Okay, China and JPY have a relationship. and China and AUD have a relationship. Okay, so technically JPY and AUD, let's say they have like a indirect relationship, right? Makes sense. So when you read your Forex Live, when you read your headline news on whatever website you see something that has to do with China, it affects not only China, but Japan as well, the GPY and AUD as well. When you read about AUD, it might affect China, maybe GPY, and so on and so forth. You make the links in your head and you play with those concepts. NZD, okay? NZD is very dependent on AUD. Like I said, it's their principal business partner. Since AUD is dependent on China, NZD is indirectly depending on China as well. So if I do the same example here, China, here I have JPY, here I have AUD, and here I have NZD. And I said D, right? Relationship here, relationship here. This is indirect relationship. And here relationship directly here. But then that means this is indirect relationship and also indirect relationship. Okay, so it looks like this. Okay, and you can do that with almost, you know, all the currencies, and you can play with the concepts. So those are all the correlationship. Okay, so China, AUD, GPY indirectly, AUD, NZD solid, but indirectly with GPY and China. Everything is linked, everyone plays together. GBP, so Brexit dependent on Brexit news, relationship with the EU. After Brexit, this currency will move based on that relationship, okay? So Brexit news pretty much over. Now that after Brexit, the relationship, the currency will move on the relationship with the EU. Deals, problems, situation of any kinds. So that's something to look for when you read your headline news. And then relationship inside the UK, basically Ireland, Scotland, England, something that's going on there, and monetary policy. So you see GBP and, you know, our China, GPY, AUD, and NZD, they are separate. They're not correlated together, okay? That's why it's very good to have GBP, okay, with JPY, AUD, and NZD, because the relationship between these currencies are almost non-existent. So I can put this one in a box and I could put these ones in a box separately. So when I make my trades, I can, you know, have one, I have two, I make 1 plus 2, it equals 3, and I can make my trade long or my trade short. Okay, very simple mathematics, very simple. Then let's get to Euro. So relationship with the USA. Trump wants to put tariffs on Euro cars, so that's something to look for. Okay, if there's any problems, EU, USA. Relationship with countries inside the EU. Okay, is there a country doing very poorly in the EU? Is a country doing very good that's carrying the EU on their back? You know, something to look for. One country can positively or negatively affect the EU as a whole. Monetary policy, economic data, of course, and Brexit, but small effect compared to GBP. And that's it for Euro. CHF, we don't trade it. We don't even look at it. But it's good to know that it's a safe haven of Europe. When Euro is not doing good, CHF will go up. Now, USD. What makes the USD move? What is personality made of? Equities market, stock indexes are going to affect the currency, of course. International relationship, Trump versus China, North Korea, EU. Those are very solid, okay? International relationship that's going also to affect, you know, our good friend gold. Okay, since it's international, gold is more of a safe haven. So basically, these types of problems or situation are going to impact gold. Monetary policy, economic data, same thing. Housing market, sensible topic for the USA, and USD is the opposite of gold, and usually inversely correlated to AUD because of gold and because of, let's say, China. USD and USA and China are going to be most of the time opposite to each other. So you can make some links with USD that is going to affect China, then China affects AUD, then AUD might affect NZD or GPY and so on and so forth. Okay, so even if we don't trade USD, we need to look at it, we need to understand it, and this will help us with the other correlation for the other currencies. CAD, very dependent on oil prices. Canada is a big producer of oil. If oil is up, CAD will be up. Relationship with USD, like I said, specific headlines regarding positive, negative issues between both countries can affect CAD and monetary policy. So we don't trade CAD. CAD doesn't have any effect, GBP, Euro, AUD, NZD, or GPY, but there's a relationship with oil. It's good to know, but I would say this is the section that we are going to use the less. Okay, we're not going to use that information as much as the rest. Gold, safe haven for the whole world, but mainly invested from the US. Okay, when shit hits the fan in the world, buy gold. When everyone is peaceful, when everyone is making babies around the world, you short gold. Very simple, safe haven for the whole world. Now, there are three principles that moves affects the market. Number one, okay, so this is very important, by the way, so pay extra attention. When a problem emerges, the currency will react negatively in proportion to the size of the problem. Okay, logical. Same thing for the duration of the negativity. However, negative news is always more, so negative news is always more powerful than positive news. Okay, so when you're reading your headline news, you need to identify, is it a problem? Is something going on with my currencies? Okay, when you find that problem, you need to see the size of the problem. Okay, is it a big problem, a medium problem, or just something that's going to be fixed tomorrow? Okay, and the duration. And the duration of that problem will be because of its size. So for example, let's say the problem is COVID-19. That's my problem on the market right now. That's what's going on. What's the size? Pretty big, I would say. I would even say very big problem, right? So you understand the size of the matter that is there, and the duration that you must ask yourself. So it's a very big problem. So is it going to last 1 week, you think? You think in 1 week it's going to be over and the market is going to forget about it and let's move on? Of course not, okay? Maybe it's going to be 1, 2, 3 years. Okay, so you know that the coronavirus, COVID-19, is going to be a topic that you are going to use very, very, very often to make your trades. So in your headline news, you know that when you see something that has to do with this, it's going to be extra important and you should really put extra energy and focus in that. Okay, and you can do the same thing with another topic that is less important, medium important, and so on and so forth. This is part of your job as a trader, to understand and put some size and understand the duration of the problem. Or number two, when a solution good event occurs, same thing as number one, the currency will react positively in proportion to the size of the good news. Same thing for the duration of the positivity. Okay, so same thing as number one, but if it's something that is positive. Number three, if there is any problem or any good news, the fundamental is flat, nothing is going on, which means it's less important, and the market is going to move according to the technical analysis. That's why you see sometimes some technical traders that don't even look at the fundamental and can be profitable for like 1, 2, 3 months. But then on the fourth month and the fifth month, the fundamental is not flat anymore. You know, the regular fundamental comes back, solutions starts to come up, problems starts to come up, and now the trading technique is worthless. Okay, their fundamental, the technical analysis, the trading technique is irrelevant because the market is not really moving on technical analysis. Okay. And that's why you need to know both of them so you can play around. When there's problem or a good event, fundamental is king. And when nothing is going on, technical, and I would say even market sentiment is king. So let's do an example, okay? Real example, so you guys understand what I mean. Example number one, simulation. So I created some situation just so we can understand easily. So US and North Korea tensions are building up for a few weeks now. North Korea continues to test their new weapon technology, but there has been no attack on the US or any other country. That's the headline. That's the current fundamental situation. Okay. How do you interpret this? Okay. Is it positive, negative? What's the size of the situation, the duration of the situation, and of course, the impact on the market? How is the market going to react? That's the thought process in your head when you have that headline news, that headline situation. You need to ask yourself these questions. What's the answer? Tensions are heavily felt on the overall currency market. All eyes are on North Korea because anything could happen at any time. And North Korea is known to be a country that doesn't play by the rules. The situation is quite negative, let's say 8 on 10 of negativity, because of the fears of escalation and the potential incoming war. Okay, you never know, something can happen and there can be a war coming out. Negativity will last until this problem is solved definitively. You have to monitor the headlines carefully. Your trading will be focused on this situation. Okay, so in our currencies that we trade, of course, North Korea, this whole situation, okay, it's going to affect the whole Asian market. So it's going to affect China, right? North Korea is in Asia, so it's going to affect the GPY. It's going to affect USD, which is going to affect gold. Okay. Then China GPY is going to affect, of course, AUD and NZD, and GBP and Euro might be affected, but very slightly. Let's say they are in their own box, but all these guys are together in the same boat. Okay, so when you're about to make your trade, you need to understand the relationship between everything here. Which one is going to, create a bigger move? Which one is the most predictable? Then you're gonna do some matching. Maybe you're gonna match this with this, maybe this with that, maybe this with this one. Maybe you're gonna trade gold, and you're gonna find which one you want to play with. Then you open your chart, you do your technical analysis, you find your entry point, and you execute the trade. Okay, so this whole network here, this whole link, that's what's going on in your head when you see something like this. Let's do another example. Okay, the president of Angola has been murdered last night due to a political conflict with another African country. That's the situation. So, how do we interpret this situation? What's the answer? The market is barely affected. It doesn't really care about this headline. Why is that? Because it doesn't affect the global currencies that we trade. Angola doesn't have an important relationship with the rest of the world. Fundamental is flat. So even if you read this headline and you might think, wow, okay, that's something very serious. That's something that is going to move something. Okay, the answer is nope. It's not fundamental is flat. It's not going to move any of our currencies. Why? Because Angola doesn't have important relationship with the rest. Okay. So it's always a question of logic, interpretation, and just basically using your head. Let's do a last example. A civil war breaks out in China to bring down the government, right? The people have had enough. They want something new. They want to bring down the government. The army is in the streets fighting the civilians. The whole country is shut down. Okay, just a bit like what happened with Hong Kong last year. Okay, but this time the whole country is in that situation. Every day the situation is only getting worse. Wow. Okay, what do we do? What's the fundamental situation? Is it positive? What's going on? How do we trade that? Uh, what we will do with our currencies? Where is the opportunity? Okay, the effect of this headline is heavily felt throughout the whole currency market. So 10 of 10 of negativity. A risk off mood is felt with the investors. They don't want to take any risk right now because, we have a pretty bad situation on our hand. It's not time to get risky with our investments. Okay. This problem could last for months, years, and will be a large part of your trading. Great opportunities and movement will be created because of this situation. Okay. So basically, first of all, gold will skyrocket, right? GPY, safe haven, boom, explodes. Okay. What happens with AUD? Boom, bad. NZD, bad also, but let's say slightly less bad than AUD because it's indirect correlation. And then GBP and Euro are on this side. They are minding their own business, sipping their tea, and doing pretty much nothing. Okay. So then you would take, let's say, I don't know, let's say if GBP is, you analyze its fundamental when it's negative, then you would make a link here and you would have, GBP negative, GPY positive. So what do? We short GJ. You find a good technical entry and you short, add multiple position, and you have a beautiful trade of maybe 500, 700, 800, 1,500 pips. Who cares? Who knows? But the important is that the trade is good and you understand what's going on. Okay. And that's how you put everything together. That all starts from the headline news, which gives you this information. And with your head, the currency correlation, 1 plus 1 equals 2, 1 plus 2 equals 3. You get this answer. This answer gives you your trade. Then you do the rest of the work and you have a good trade. Okay, so that's the process. So we have a few more examples, but you can look at them on your own time. So example 4, example 5, example 6. Have fun with that. 7. Actually, I did put a lot of example. 9. So have fun with that. Okay. At home, you can try to understand them by yourself. Use them as a practice. Okay. Now, once we understand all of that, we can do some extra research if you want, if we want. So if you need more information than what is available for Forex Live, you are going to do research on the other news site and on Google. This will allow you to push your reflection and have a more accurate fundamental idea. Okay? Warning, this is very important. Okay, I see too many students making this mistake. Do not overcomplicate your fundamental. You are not an analyst, you are a trader. You must know enough to get a market bias and a direction. Okay, keep it very simple. But you mustn't begin to do a statistical analysis of every little detail fundamental and getting like Excel spreadsheet and weighing, with a mathematical formula. Every headline at the end gives you a number that is, and so on and so forth. I saw some students doing that. That's way too complex for nothing. It doesn't matter. Okay. This will bring more confusion and you won't be able to make straight market decision. Okay, it should be very simple, very straightforward. The links should be very easily made, just like we did in the last few examples. Okay, but never overcomplicate. Keep it simple, straightforward. So you must be able to take a lot of information and basically digest it and make it very simple to understand and to use. If you have too much fundamental information, too many fundamental ideas, it's going to be too heavy. You're not going to be able to use it in the market, because inside of your fundamental idea, there's going to be many contradictions and you won't be able to make straight market decisions. So always keep that in your mind. And now, the grand finale, the creation of the fundamental idea that we started doing just a bit before. You will take all the information you have acquired in your previous fundamental work, economic data analysis, headline news analysis, research online, and create your fundamental bias idea. Before even looking at the chart, you must know in which direction the market is heading. Okay, and when I say must, that's when the fundamental is not flat. Okay, when the fundamental is not flat. Okay, if the fundamental is flat, you don't need to know the direction of the market way before. Okay, I would say maybe 70% of the time, 75% of the time, the market is not flat. Okay, but let's say that 25% of the time that the market is flat. Okay, you don't need to know the direction of the market before you open the chart. The chart are going to do the talking. They're going to give you the story. Okay, so sometimes you're going to have an inversion. So all of that here, 75% of the time, still applies to the 25% of the time that the fundamental is flat, but a bit less. Okay, so once again, use your head for that. So for example, let's say GBP, I have interest rate hike, second referendum, and cancellation of Brexit, for example, and this is positive for GBP. GPY, we have end of US-China trade war, deal made plus high unemployment rate and expectation of a rate cut in the next 3 to 6 months. That's negative for GPY, because the end of the US-China trade war means it's positive for China, positive for the USA, and GPY as a safe haven loses its value. GPY strong, GPY weak. Wow, 1 + 1 = 2, long GBP GPY. Is it magic? Is it trading? We don't know, okay? But it's very simple at the end of the day. You see how simple it is? 1 plus 1, well, actually, not 1 plus 2, 1 plus 1 equals 2, okay, positive. 1 plus 1 plus 1 equals 3, which is negative, okay. 2 plus 3 equals 5, which is long GBP, GPY, okay. Don't overcomplicate your fundamental analysis. You should keep it clear, concise, and easy like that. But it takes work to find that information, okay. Another example, euro, nothing really going on fundamentally, so that's flat. Nothing going on. AUD, great jobs report and economic growth causes interest rate hike plus coronavirus situation is finished. Let's say euro is neutral and AUD strong. So what do? Short euro AUD. But you know that this movement here is going to be driven by the AUD, not by the euro. Okay, so you know that in your mind. So if there's some new fundamental information that shows up here or shows up there, you will know how it's going to affect your trade. If euro in the next few days, something comes up and, for example, it gets positive, something positive comes out, this was positive too, okay. What will happen with our short euro USD, AUD? It will start to do a bit of consolidation. Even if it did not reach your take profit, here you have a conflict of interest. You have positive, which will create that consolidation, which will stop the momentum of your trade, which means that there's a probability that your trade will not reach its take profit. And that's a good moment to just close your trade. Your fundamental idea is not valid anymore. You have the chance to be in profit, close the trade, and move on to the next one. So we keep it simple, but sometimes there is some work to do after the fundamental idea, and sometimes you have to cut your trade a bit short. Let's do a last example. So for example, for gold, let's say, tensions between US and North Korea, US tariffs on cars, conflict between China and Australia. This is bad for everyone, but good for gold. USD, interest rate cut plus bad jobs report, which is negative, very simple, long gold, okay, until this situation changes. And I think you guys get the idea. So the other examples, you can look at them. Well, actually, there's one last example, but you can look at it in your spare time. And I want to end this section with just a small analogy, okay? The creation of art. If you take a beautiful masterpiece, a beautiful painting like this one here, okay? Starry Night by Van Gogh. If you think about the process of creating a piece like that, and it could be any art piece, okay? Do you think the artist just wakes up, takes his blank, canvas here, takes his paint, his tools, whatever they are, his brushes, his pencils, and just start drawing and create something without really having an idea of what he wants to draw? That's not the case, okay? An art piece, a masterpiece, something that is beautiful, something that is created, okay, has to start with an idea, okay? It all comes from there. The idea could be from a dream, okay? The idea could be from an experience. The idea could be from a walk on the beach. It doesn't matter. It starts with an idea. It's the master in the process, okay? With that idea, the artist takes it. It's clear in its head. He knows exactly what he wants to portray, exactly what he wants to show. And then the artist will take his tools, will take his, let's say his accessories, paints, everything. Okay, he will use his technical skill set to do what? To execute the idea. So the idea, right? Execute this idea from the start, and the execution is going to be on the canvas from that idea, and this will become a masterpiece. Okay, you cannot create a masterpiece, you cannot create this painting by just taking your technical skill set with your tools and your paint and just doing, random stuff on the canvas and creating something by chance. It doesn't work like that. Okay, with the idea, okay, let's do the comparison with our trading. The fundamental here, which is based on not your dreams, not your experience, not your walk on the beach. It's based on the economic calendar. It's based on the headlines, and it's based on the market sentiment. This gives you your idea. And then your tools here, your technical, that's your support resistance. Those are your trend lines. This is your fib. And with that, you execute your idea, and your masterpiece is your trade. And the masterpiece is the plus 500 pips on the trade that you just did. Okay, that's how it is. That's how the process is, should work in your head. That's how you become a good trader. You must understand that. You must master that. You need to create that process and recreate it over and over and over and refine it. And that's how you make good trades. And that 500 pips becomes money, right? And that money gives you some compounding on your account, so your account grows, right? And then with that, you live life, right? Then you enjoy life, you go travel, buy a house, take care of your kids, and that's the cycle of trading. Okay, and no one is going to tell you this because they have not reached that level yet. Okay, so that's the truth, that's the process, and that's it for the fundamental. Okay, so let's take a break. Okay, lunch break. Keep your questions if you had the question for the fundamental section. And let's be back in 45 minutes. Okay, so at 1:30 p.m. in 45 minutes, let's be back to continue, and I'll answer your questions. All right, so have a good lunch, guys, and I'll see you in a bit.